Hi, guys. Welcome to today's episode of the Pi Podcast. I am your host, Irene, and today we begin our series on building generational wealth. Today's episode is informed by reports from leading private banks, and we're going to look at how the insights that we get from today can help the day to day investor and family um, in terms of gaining insights on how to build a portfolio that will stand the test of time. So let's get started. Now, the 1% are seeking advice from professional investment advisors, and this is a majority of them. So I would suspect that they are essentially looking to get the best industry knowledge possible to be able to have a resilient portfolio. They're looking for opportunity sets that can help broaden the portfolio horizons that they have. And so we're seeing a lot of allocation, at least 40% of allocation of their assets into alternative investments. So alternative investments are not your typical stocks or bonds or cash. These are investments that sit in the alternative space. And just to give you a couple of examples, you have your real estate, you could have your commodities, which includes oil, gold, perhaps coffee. You also have your collectibles, which is perhaps your art, your vintage cars, and your wine. You have private equity and private debt, which is about investing and lending to private companies. You've also got your hedging instruments, which help manage risk, and your structured products, perhaps like your mortgage backed securities. That's probably more relatable from the angle of the 2008 financial crisis, where we had mortgages packed into a product that essentially led to a market crisis. Now, the target return that they're looking for when it comes to alternative investments is 11%. And we know since the start of the stock market, the average return tends to be around 10%. So, what we can see from this strategy is that the risk profile of this asset is higher than the average risk profile. Now, as we talk about risk, we have three different types of risk. We have your low risk, your medium risk, and your high risk. So, depending on your risk appetite, which is essentially going to drive a lot of your investment decisions, this then determines how you're going to invest into your portfolio. Now, I would suspect they're looking for higher returns and they're probably looking for more sophisticated types of assets, and therefore they're going for alternative assets. Because remember, at 11% target return is not necessarily the return that they do receive. They could receive higher than 11%, they could also receive lower than 11%. So that risk profile shows you sort of the risks and rewards of being perhaps a higher risk investor, that you could significantly gain or you could significantly lose. So for the day-to-day investor, it's good to understand your risk appetite and understand perhaps platforms where you can learn more about alternative investments. So just to give you a couple, we have the Cedars platform in the UK, and I believe this is accessible globally. You can actually go in there, and what they've done is a really good job. They've actually analyzed different types of up and coming and scaling businesses that are looking for funding, looked at their financials and looked at their track record, and then placed them on the platform for different investors to look into. So what you do is you go on the platform, have a look at different investors that you might go on the platform, have a look at different types of businesses that you might be interested in, and then proceed to make your investment in them. Now, this is not financial advice, as I have said, so speak to your financial advisor to understand how this fits into your portfolio. There is another one called crowdfunding, which is perhaps more popular. And this is where individuals and businesses seek funding from, again, the public, which is the investors. They put forward their business proposals and then proceed to request funding from there. And this opens you up to a whole different universe where you can invest in companies that are significantly young, companies that could essentially turn out to be, million billion dollar companies. So it's really a risk that you are taking. But if you do feel strongly about having that diversified portfolio and having alternative assets within it, these are some of the platforms that you should begin to get familiar with, understand how they work, and then seek the relevant advice before making those decisions. So, as the 1% are using investment advisors, us day to day investors and families need to be able to have financial advisors on board to be able to support us as we make these decisions, understand our risk appetite, and understand some of the different alternative assets that you could invest in as well to support you through this journey. The next thing that we can focus on is the fact that the 1% are really involved in decision making, and this would lead me to believe that they're looking to have more control over their investment strategies and their investment decisions. Now, at least 90% of them report that the family members are involved in making investment decisions, with 50% saying that the family principal is responsible for making decisions. So, this applies to us as day to day investors as well, looking to build generational wealth. It just lets us know that we need to involve our families when it comes to making decisions. Now, why is this important? It's important to take the family along this journey because anything could happen, and you then find yourself in a position where there's gaps in knowledge. And so, any member of the family could then potentially step in to be able to fill this gap. Now, the other thing is if you're looking to have succession planning in place, it just means that you're preparing your family really well, giving them the opportunity to really understand how decisions are taken, what drives the decisions, what the family values are, in order to support them continue to preserve and grow that portfolio over generations. Thirdly, the 1% have actually employed governance structures in place to support them with building stronger family ties and family unity. Now, this is something that we actually need to take very seriously as investors and as families because some of these things are essentially the reasons why families tend to fail when it comes to building generational wealth. There are only few families that have managed to pass generational wealth through more than, 4, 5, 6, 7 generations. And many families tend to have this issue where wealth is squandered by the second or third generation. And I believe it's significantly led by the family values and the unity that's involved. So, if you do not have the right family unity, then it becomes a challenge when it comes to making investment decisions and really practicing your family values when it comes to succession planning. So, we as day to day investors need to make sure that we are cohesive as a family unit. We're putting the right governance structures in place. We're, transferring the right values through the family and through generations to be able to maintain that unity that can then support us build wealth over the long term. There is a terminology that's, well, a phrase that's used in business, and it states that culture eats strategy for breakfast. And so having that family unity, having that culture and your defined values as a family is essentially going to be the main reason why your family's wealth is going to successfully be built, preserved, and transferred over generations to come. So, family offices are also reporting that they have gaps which they need to focus on. And this is very good because it makes them very human when we compare ourselves to them or when we look at, the level that they are at and where we're trying to get to. Now, I'm not saying everybody is trying to, be in the 1%. I'm sure everybody would like to be financially secure. And for those reasons, it's important that we all acknowledge where our shortcomings are. And so for the family office, they're talking about, gaps in cybersecurity, they're talking about gaps in succession planning, and they're talking about gaps in education and knowledge when it comes to financial literacy. And these are the same issues that actually everybody is facing in the world today. So if you think about cybersecurity and the fraud that happens, on a day-to-day basis, the numbers are significant. And I'm sure if you are not somebody who's been a victim of financial fraud, you definitely know somebody who has been. And so it's important for us to be vigilant as, people who are in a technical age. We need to be very careful about who we give our information to and how this information is being used, make sure that our data privacy laws are being observed and that we're not putting ourselves at risk of any type of financial fraud. Now, if you do happen to be a victim of fraud, there are ways that you can recover anything that you have lost. However, having done your due diligence before this event would be the most important thing that will actually back you up when you go to perhaps your bankers to explain to them what has happened to you. So, for example, I had an incident where I made a payment to a company that actually did not deliver the services to me. This was a legitimate company. They were registered on the company's, register. I attended an event in person, met the people, and so I knew this was definitely a legitimate business. But because they were not able to deliver the service, I was unable to go to the bank and let them know I had done my due diligence before I placed my transaction. And for those reasons, they were able to do a bit of digging into it, and then they came back and refunded me that money. So it's very important to be able to have a leg to stand on if you are a victim of financial fraud. There is something about negligence that just does not, facilitate the need for institutions to support you in this case. So I cannot stress enough how important it is to be very wise, savvy, and switched on when it comes to operating and, financial transactions across the internet and in general. Now, succession planning is something that we have talked about in the previous point. And this is essentially where assets and wealth are transferred through generations. Now, the main point when it comes to succession planning is having the right culture and the right family values in place and having the correct governance structure to help you execute on that. So, governance is a topic that we are going to explore a bit more in future episodes to really inform you on what this would look like to be able to have that successful governance structure that will help facilitate your family's endeavors when it comes to building, preserving, and transferring generational wealth. Financial literacy and education being another point of concern or a knowledge gap when it comes to the 1% is also something that we have all acknowledged globally. And the best thing for you to do is actually invest in resources that will help you understand the gaps that you have and help you gain the knowledge that you need. Now, there's a lot of content creation out here about financial literacy. A lot of it is good and a lot of it is not good. So it's really up to you to be able to find the valid sources of information, really look into it, make sure all the information that you're receiving is regulated. And the best way to be able to do that as well, and I will keep banging on about this, is for you to seek a financial advisor's assistance. Now, from today's episode, based on all the points that we have discussed, if you are to meet with your financial advisor, you would let them know that we have discussed, points around having alternative assets in place. We've talked about succession planning. We've talked about being in control of decision making. We've talked about culture. And so, how do all these things impact my portfolio and how can I implement them to get the best chance at having a successful investment strategy in place and give me the best opportunity to build that family wealth. Coming to your financial advisor from a place of knowledge is also an advantage because it keeps them sharp, it keeps you sharp, and it lets them know that actually I'm really serious about these things and I'm interested in these things. So sometimes you might find that if you don't mention something to your advisor, they might not know that you're interested in it. And so it's just good, as much as it does not apply to you, maybe that's why they're not mentioning it. But perhaps if it does not apply to you, it's still good to have that information in mind because it might apply to you later down the line and you might remember there was something that we discussed that I actually really like the sound of and I would like to have this implemented into my investment portfolio. Now, the final point is that the 1% are essentially investing in their family offices. So, family offices are essentially how the 1% manage and invest their assets. So they build a structure, say, for example, a fund or an office, which is essentially a business, and they have all sorts of advisors. Working there, all sorts of professionals who can help manage their investments and help them with their decision making process. Now, this is not a cheap, process by any means because seeking the help of professionals comes with a price tag to it. However, they are still making that decision to invest in themselves. And so, like I've pointed out in the previous point, we need to invest in ourselves, whether it's through education, whether it's through paying for financial advisors to give you their insight, whether it's through spending your time and just doing your own research and listening to podcasts, really understanding the things that will impact you as a family. And again, investing in the knowledge that you're sharing and transferring to your family. I think these are all key points that we can benefit from. I hope today's episode has been informative and it has given you some insights into how we can leverage some of the good practices that we're seeing across family offices in order to build our own family's generational wealth. Thank you for spending your time with me, and I'll see you next time. Bye for now.